Hello everyone, and welcome to Virginia International University's MBA 636 Managerial Accounting Chapter 6 course. Today what we're going to do is talk about cost behavior, and that really refers to what do costs do when production volume changes, right? And this is important to management because we use that information with respect to projecting budgets, projecting other different types of metrics that are related to the budget, such as sales volume. What do the costs do under particular sales volume assumptions? What does that mean for revenue? And so understanding this idea of cost behavior becomes important from that perspective. And so during the first objective we have is that we want to talk about what are the key characteristics and graphs of various cost behaviors. And again, when we talk about cost behaviors, we're talking about how do costs change as volumes change. So do costs increase as volume decreases? Do costs decrease as volume increases? What happens to total cost as volume changes? And we generally think of three common cost behaviors, and you've probably heard these before in other classes: variable cost, fixed cost, and mixed costs. So with variable costs, what we're talking about is where total variable costs change in direct proportion to changes in volume. So variable cost per unit remains constant. So this says if I have a variable cost per unit of $6 per unit, it doesn't matter whether I manufacture my first unit or my 1,001 unit or my 100th unit. My variable cost is still $6 per unit. So my total variable costs change in direct proportion to changes in volume. So if I produce 1 unit, it costs me $6. If I produce 100 units, it costs me $6,000. But it's because I increase my volume that my total variable costs change, not because the total or the variable cost per unit changed for each additional unit of volume that was increased. So variable cost per unit remains constant, and then we talk about the slope. So where we have zero volume, we have zero variable costs, right? Because if I'm not manufacturing anything for variable costs, I'm not incurring any cost. So the slope of the line is what gives us, or the cost line is what gives us what our total variable cost per unit is. And here we see our formula that my total variable cost, Y, is equal to my variable cost per unit of activity, V, times my volume of activity. And so in our previous example, my total variable cost of $6,000 was equal to my variable cost per unit of $6 per unit times the 1,000 units of activity. And so here we're looking at a cost graph of variable cost, and we can see that the point of origin on the graph to the left is at 0, and the graph to the right, that's just called our point of origin, and we can see that costs are 0 there, and that makes sense to us, right? Because we don't produce anything, we don't incur any variable cost. And the vertical axis Y shows us our total cost. So there we see we start off with $6 per cost at 2 units. If we produce 2 more units, if it costs us $3 per unit, and so we know that it costs us $6 per unit for 2 units, that's $3 a unit. If we produce 2 more units, our variable costs go up to $12. And so again, we can see that the slope of the line it gives me my total variable cost. Right? And here we see the total cost being shown on the y-axis, and the total volume of activity being shown on the x-axis. And then finally, we want to note that the variable cost per customer remains constant in each of the graphs. Right? And so in the graph to the left, my variable cost per unit is $3. In the graph to the right, my variable cost per unit is $10 because I'm for a volume of 2 in the graph to the right, I'm at $20 in total variable cost. In volume 3, I'm at $30. And so this graph just shows us another example here. And suppose we assume that we have a 5% sales commission, right? And to the left are my total sales, or on my y-axis are my total sales commission ranging from 0 to 2,500, and on the right are my total sales. And if I have a 5% sales commission, right, then what this shows is that if I have 0 sales, well, obviously I pay no commission. And so that's why at my origin, I have $0 in sales and 0 sales commission. But at 5% per dollar of sales, we can see the slope of the line, and we can see the characteristics of that line and how those sales commissions increase as my total sales increase. And they increase proportionally to the sales. And so next we want to talk about cost equations, how we use cost equations to express and predict cost, because all of this is good to know, but it's nice to see it on graphs, but somehow we have to be able to translate that into something useful for managers. So a cost equation is a mathematical equation for a straight line to predict a total cost. And an example of one is that total cost is equal to total variable cost plus total fixed cost, or we can substitute in our previous abbreviations for total cost being Y. Variable cost is equal to my variable cost per unit times the volume of activity that I have, and then total fixed cost is equal to F. So now let's talk about a few examples of fixed cost, or some characteristics of fixed cost. So fixed costs remain constant over a relevant range. And this idea of relevant range is important because if we think about, for example, I lease a factory. So I lease the factory and it will manufacture up to $1 million or 1 million units of production. So my lease, I have very little flexibility because I generally have to sign some sort of lease agreement, which may be very difficult to get out of, very expensive for me to get out of, it may be long term. So I have not as much flexibility to impact that cost, but it also provides me with the ability to manufacture 1 million units. And so I can come up with what my fixed costs are per unit, knowing that for 0 to 1 million units. But the minute I reach 1,000,001 units, I can no longer use that factory, and so perhaps I have to expand, or perhaps I have to lease another factory that may have a different cost component to it, right? So we think of that 0 to 1 million to be my relevant range. And so it's important to note that our fixed costs stay constant over that relevant range. And then fixed costs per unit of activity vary inversely with changes in volume, right? So here we're talking not the fixed cost doesn't vary with the change in volume, but the per unit fixed cost of activity vary. And so obviously if I pay $1 million for my lease for my factory and I produce 1 million units, then my fixed cost per unit is $1 per unit of activity. However, if I only manufacture 500,000 units, I still have $1 million in lease costs that have to be spread over the 500,000 units. So my fixed cost per unit is still $1 million, but my fixed cost is still $1 million, but my fixed cost per unit is now $2 per unit, or the $1 million divided by the 500,000 units of production. And so our cost equation for this is total fixed cost Y equal to fixed amount over a period of time, right? And that's simply Y is equal to F. So my fixed cost per unit, total fixed cost, is equal to the fixed amount over a period of time. And we want to keep in mind that the relevant range is the normal operating range of activity. And so this line shows us, or this graph shows us, the relationship between a fixed cost. And on the left we have total sales salaries, and that's the y-axis. On the x-axis we have total sales. And what we see is that if we think about someone's compensation being broken down into a base salary plus commission, well, their base salary then becomes the fixed cost, because we have to pay them their base salary whether they sell anything or not, right? And so their base salary, and we're assuming here it's $2,000, whether it's a month or a week, but it's $2,000. And we see that that line is straight, and we see that the point of origin is the fixed cost point of origin, not zero, because even if we don't have any sales for at least some period of time until we terminate that person for not making any sales, even if we don't have any sales, we're going to have to pay $2,000 as a fixed cost. And so we want to talk about a few other types of costs. We talk about committed fixed costs, and this is where the business is locked into the cost due to some previous management decisions, and they generally cannot change these in the short term. And an example we talked about earlier was this long-term lease. And then we talk about discretionary fixed costs, and they can be adjusted in the short term, right? And so we think of discretionary fixed costs, maybe that is the salary of some management that, it's fixed because we've got to incur it over a period of time, but barring any unusual employment agreements or anything else like that, we're able to impact that level of fixed costs by, either adjusting the salary, lowering the salary, terminating the manager. I mean, there are ways to impact the discretionary fixed costs that we don't have with committed fixed costs. And then we want to talk about this idea of mixed cost. So mixed cost or total mixed costs do increase as volume increases, but not in direct proportion, right? And so mixed costs have both variable and fixed components to them. And total mixed cost can be expressed as a combination of variable and fixed cost equations, and that looks like this. Total mixed cost equals total variable cost plus total fixed cost, or y equals vx plus f, right? Where y equals the total mixed cost, v and x are the variable cost per unit times the volume activity, and f is the fixed cost over a period of time. And a good example of a mixed cost might be something like my running a hotel. So if I were to have a hotel and I have utilities, well, I have a base amount of utilities that I have to have regardless of whether I rent any rooms or not, right? So I have that fixed cost component to my utility bill, but as I rent more rooms, my utility bills goes up somewhat incrementally because I have guests in the room, they're using electricity, lights on, more heat on, and so on and so forth. So that's a good example when we think about what might be reflective of a mixed cost. And so here we have a graph that shows us a mixed cost, and we have a fixed cost component to mixed cost, and we have a variable cost component to our mixed cost, right? In this example, we've got the fixed cost, which is the if we think about a salesperson's compensation who makes a base salary plus a commission, the fixed cost is their base salary, and that's the red line. The variable cost, which is what they make in addition to the base salary based on the volume of sales, 5% commission on a volume of sales, gives us our variable cost component. So now let's turn to problem S6-1 in the book, and let's just see if we can't identify some of the, based on some cost behaviors, whether something is a fixed, variable, or mixed cost. So we have cost relationship A, where total cost is at 5,000 units, total cost is $30,000, and so we have a cost per unit of 6. At 6,000 units, we have total cost is $36,000 per unit, and the cost per unit is at 6. So the question is, for cost A, would you say that's variable cost, fixed, or mixed? For cost B, we have at 5,000 units, we have $30,000 in total cost, or a cost per unit of $6. And also for cost D, at 6,000 units, we have $30,000 and a cost per unit of $5 per unit. So essentially cost B, we say that going from 5,000 to 6,000 units, the total cost doesn't change, versus cost A, where going from 5,000 to 6,000, the total cost did change. And then finally we have cost C, where we go at 5,000 units from $30,000 at a cost of $6 per unit to $33,000 at a cost per unit of $550. So would you say that A, B, and C of those three, which one is variable, which one is fixed, and which one is mixed? So A we say is variable, right? Because the cost per unit didn't change. Our total cost went up from 5,000 to 6,000, but our total cost per unit didn't change. How about cost B? Is that we got fixed and mixed left? And so I hope you said fixed, because we can see that while our cost per unit changed, and so we expect that because our number of units produced went up from 5,000 to 6,000, our total cost didn't change any. And so that leaves us with mixed costs for C. And there again, what we can see is that the cost per unit changed, right? It went at 5,000 units we were at 30,000, and at 6,000 units we were at 33,000, but they didn't change proportionally like we saw in cost A or cost B with no change at all in total cost. So we consider those to be mixed cost. So now let's talk a little bit about this idea of relevant range, because we know that's important. And when we talk relevant range, we're talking about a band of volume where total fixed costs remain constant at a certain level, right? So again, I'm back to my the lease of my warehouse. You know, the warehouse is big enough, the equipment that's in my warehouse, everything that I'm leasing for that operation is going to cost me $1 million a year, and it doesn't matter if I manufacture 1 unit or I manufacture 1 million units, it's going to cost me $1 million to have that factory. So that's an idea of fixed cost, right? And that doesn't change between 0 units and 1 million units. And versus variable cost, which within that same relevant range would stay the same, right? So if my relevant range there might be 500,000 units, so that doesn't matter whether I manufacture 0 units or 500,000 units. If I have a $6 per unit variable cost, that variable cost doesn't change over the relevant range. Right? So that's this idea of relevant range, and this becomes important later when we talk about regression analysis, and you may have dealt with that in other statistics classes. So we do have some other cost behaviors, and one idea or one example of an other cost behavior is a step cost. And you can see they're fixed for a certain period of time, and then something happens and they increase, and then they remain fixed for another certain period of time at the 30,000, and then something happens when we reach another number of units of production that increases to 45, and so they just look like stairs, so we call them stair step costs. And or step cost, step cost. And these characteristics, these costs have characteristics of fixed and variable. And a good example of this would be caregivers in child care centers, right? So generally, regulations say that for X number of children, I have to have 1 child caregiver. So perhaps it's 10 for every 10 children, I must have 1 full-time child caregiver. But the minute I get 1 more child, 11, I have to add another child caregiver. So, and then the minute I get 1 more, or 21, I have to add another, and so on and so forth. So you can see how the cost increase at some point in time. Something happens at some point in time. And in this example, was I get 1 more additional child, but between that 1 child and the next 9, I don't have to add any more caregivers. So my costs remain constant over that period, or over that number of children. And then we have this idea of curvilinear costs. So these are not linear costs, and they don't fit a neat pattern. So sometimes it's necessary to approximate this type of cost as a mixed cost. And so we just can compare the curvilinear line superimposed on the total cost line. A total cost curvilinear line is superimposed on a total cost linear line, and you can see that sometimes because of different cost characteristics of different inputs to the equation, it's not a straight line. So in those cases, like I say, we just kind of have to estimate sometimes what these behaviors will do to our total cost. And so then we want to talk about this idea of sustainability and cost behavior. So sustainable companies and changes in cost behavior, for an example of that is e-banking and e-billing. So with e-banking and e-billing, we drive down the variable cost because we no longer have to provide hard copies, paper copies of bank statements, and we don't have the printing of those, we don't have the mailing of that, but we do have to think about other costs that we incur as a result of e-banking, and that's the development of websites and the security around those, right? And so, we're looking at how might our cost behavior change as a result of going from a paper-based banking statement process to an e-banking or e-billing activity, knowing that they're not going to eliminate, or it may eliminate some costs altogether, but it may introduce all new costs as well, or completely different costs. And in that case, we need to decide, well, are those costs now variable or fixed? How do they change in relation to our customer base? That also results in greener lifestyles, and we also can think about the environmental impact when we're looking at these cost behaviors. So for objective 3, we want to talk about how we use account analysis and scatter plots to analyze cost behavior, right? Because it's good to know these exist, but without being able to understand what their impact is on us, doesn't do us much good. So we have 4 methods to analyze cost behavior, and these are listed in order of least accurate to most accurate. We have account analysis, scatter plots, the high-low method, and regression analysis. And regression analysis, we'll talk about it a little here, but we're not going to get into it very much. But that's something you would have covered in one of your business statistics class. It's a powerful tool, and I highly recommend you understand it to the extent you're really seriously going into some sort of accounting or business analysis side, because it is a strong tool and it's not well understood. And so I think it will give you an advantage over other people if you understand. Sometimes it's simple regression analysis where we're just analyzing one variable's impact on cost. Other times it's multiple regression analysis where we're comparing the results using multiple different variables. So with account analysis, it's very subjective, and we're really just visually determining the strength of a relationship between a cost and volume. We go down our trial balance and we look at each individual general ledger account, and we sort of subjectively decide in looking at that, well, is that a variable cost or is it a fixed cost? And so, for example, I might look at my depreciation expense and say, well, that's a fixed cost because I bought an asset, and it's going to be, unless I sell that asset, it's going to be difficult for me to impact the, to impact that cost, versus perhaps direct labor, which I would look at as an expense on the general ledger and say, well, that's a variable cost because it should change, and I do have a way of impacting that more directly. So account analysis, again, we're just going through the general ledger, and account by account, we're determining whether it's a fixed cost or a variable cost, and for that purpose it is very subjective. With scatter plots, we're using historical data to determine a cost behavior. So we're plotting on a graph the relationship between a particular cost and a particular volume or unit of activity. So the scatter plot is the graph of historical cost data on the y-axis and volume on the x-axis, and we've seen those earlier in the presentation. And so again, it helps managers visually determine how strong the relationship is between the cost and the volume of the chosen activity base. So let's look at an example of a scatter plot. So here all we're looking at is the total cost and the relationship of total cost to miles driven, and we plotted certain data points, right? The blue diamonds are the data points. And so the slope of a line that would connect all of those plots tells us how strong the relationship is, right? So a straight line sloping up to the right says that there's a very positive relationship, right? And again, this kind of helps the manager visually determine the strength. It helps us to also identify outliers, right? And we would want to understand what the reason for certain outliers might be. But again, the slope of that line is equal to the cost per unit. And next we want to talk just a couple of minutes about the high-low method to analyze cost behavior. And this has certain advantages and disadvantages. So for step one, we want to find the variable cost per unit or the slope of the cost line. Then for step two, we want to find the fixed cost or what we call the vertical intercept, right? Because we know that that's not the point of or that's not the origin for fixed cost. And then we want to create the cost equation. And so the advantage is that it's easy to use. We're really only talking about two data points, right? The high point and the low point. And but the disadvantage is that it only uses two data points because that doesn't give us much data in our equation to really very accurately predict what may happen in between those two data points. And so next we want to talk about regression analysis. And with regression analysis, what we're really doing, there are a lot of statistical packages and Excel as well, Microsoft Excel, that provide us with the functionality to calculate the regression analysis. And we really tend to rely on those now that we have them. It's really a matter of understanding and being able to interpret the results of that. So with regression analysis, what we're trying to do is to use a statistical procedure to find the line that best fits the data. That is, use a regression analysis to determine our cost equation. With regression analysis, we use all data points, not just the high and low, and we end up really with three particular important measures. One is the R-squared, which is highlighted in yellow, and then the other is the intercept, which is where the line intercepts the y-axis, and so that essentially gives us a fixed cost component, and then the x variable 1, which is the where the line intersects, or it's the variable cost associated with each unit of production. So again, we're looking at a statistical procedure to find the line of best fit that through data. We use all the data points and we end up, for our purposes here, with an R-squared, an intercept, and an x variable 1. So let's talk about how we interpret those. So the intercept, which we see down at the bottom of the page highlighted with a coefficient of 14,538.05, that is our fixed cost. So that is the point on the y-axis that the line intersects the y-axis for the relevant range of data we're considering. The x variable is the variable cost per unit of activity. So if we think about our equation of y, which is total cost, equal our variable cost times our volume plus our fixed cost, then the x variable 1 is the variable cost per unit that we're multiplying our volume by, or x. And here, in this case, it's $7.85 roughly. And then finally, we look at R-squared. And R-squared really just tells us, it's a measure of fit, right? It just tells us, well, how much variability in total cost is accounted for by changes in the variable cost per unit and the fixed cost over that relevant range. And here, so we talk a utilities monthly cost equation. If we're looking at this, in this example 6-15, in this example, the utilities monthly cost equation would be equal to, remember, it's, so y is equal to my total cost equals x, which is my variable cost, times v, which is my units of production, plus f, which are my fixed cost. And so if we pull those amounts out of this, the result presented here for regression analysis, we see that y is equal to $7.85 times x, so whatever my volume is, plus the $14,538, which is my fixed cost per unit, right? And this is where, so y is equal to my total monthly utilities cost, and x is equal to my number of guests. So, and this is, like we say, so this is really talking about a monthly utility. My monthly utility bill to maintain my hotel, we're going to say, is $14,538, even if I don't sell any rooms. But when I start selling rooms, then that increases by $7.85 for each guest that I get. And so this is how we can use this regression analysis to help us understand that. And then we have to talk about what this R squared value of 0.94 is. And we refer to R squared as a goodness of fit. It really talks about how well does the line fit the data points, and it'll range from 0 to 1. And so any R squared that's greater than 0.8 indicates that it's that the cost equation we get from that we just looked at is very reliable for predicting cost within the relevant range. And that's cost across different volumes, right? So again, it's within the relevant range. Anything between an R squared between a 0.5 and a 0.8, we want to say that we use it with caution, because there's some question about how well the line fits through the data point, and anything less than 5, we just wouldn't use, because it really tells us there's not a very good relationship between the activity driver and the cost that we have, and so we really shouldn't be using that activity driver to estimate what our total costs are. So we would just not use that analysis if the R squared is less than 0.5. And so when we're predicting costs, there are a few concerns that we have to deal with, and these are generally around the data that we're using. As we talked earlier, we only want to use data within the relevant range, because when we get out of our relevant range, that's going to obviously have an impact on the data, which obviously is going to change what our equations would be. We want to keep in mind that there are seasonal variations, right? So the data has to be across some relevant time frame as well. We want to keep in mind inflation, right? That could drive up cost. And we'd want to make sure we understood, well, it was a highly inflationary period or highly inflationary year. For some, maybe perhaps fuel is a good example, right? We have some industries that are highly driven by their costs are highly driven by the cost of fuel. So is fuel, has it been highly inflation? I mean, most recently, at least during the time of this recording, fuel costs have gone down significantly. So, would we really want to use that to come up with some cost equations, knowing that it's moving in a direction it hasn't generally moved? And then we want to understand what these outliers or abnormal data points are. They're part of our data. We just need to understand what they are. And then finally, we want to talk about this idea of variable costing and how we prepare a contribution margin income statement. So when we're talking about absorption costing, right, we want to keep in mind that absorption costing is required by GAAP for external reporting. You cannot prepare income statements and have them audited and issued with a clean audit opinion using variable costing. You have to convert it to absorption costing. But these income statements are audited income statements are targeted for external users. Internal users may very well want to know what my costs are and what the income statement looks like for internal decision making using a variable costing approach. But under absorption costing, so now we're going to switch back and talk about absorption costing, we assign all manufacturing costs to products, right? So we're saying that when we create or transfer costs, as we saw in an earlier chapter, between various inventory accounts, then those costs that are moving between inventory accounts include my direct materials, direct labor, any variable manufacturing overhead, as well as fixed manufacturing overhead. So we are inventorying our manufacturing overhead costs because they're considered to be a part of the product. Compare that to variable costing, though, where we consider these fixed overhead costs to be period costs and they get expensed, so they don't get put on the balance sheet. And for absorption costing, we end up with the traditional or conventional income statement that we talked earlier, gets audited and gets released to external users. The difference between absorption and variable costing is that fixed costs are product expenses and variable costs, but for variable costs, they become period expenses, right? So And all that means is that under absorption costing, my inventory is including a component of my fixed overhead cost. For variable costing, my inventory doesn't. Those fixed costs are considered to be period costs, so they're expensed in that period. And so this is an example of a traditional income statement. We start off with sales, lesser cost of goods sold, which gives us a gross margin, and that tells us how much do we have to go toward covering functional expenses that are related to our selling, general, and administrative expenses, which get us down then to operating income. So this is really a functional, it's talking about what people do in their role. Do they fulfill a selling, general, and administrative role? And that gross margin tells us how much we have as a result of sales activity to cover that to get us to operating income. And a lot of places will we call this operating income because it depends on how we measure the performance of managers, because it may be that there are expenses beneath operating income that our managers really don't have any control over, and so their performance is gauged on operating income. So this we compare to variable costing, and as we said, a variable costing assigns only variable manufacturing cost to products. So with variable costing, we're simply assigning direct material, direct labor, and variable manufacturing overhead to our product cost. We treat fixed manufacturing overhead as a period cost, and it gets expensed totally, completely in the current period. We usually use this for management decision making, and we don't have that traditional income statement. We use a contribution margin income statement. And what a contribution margin income statement tells us is how much are we generating that goes toward covering not the functional cost, right? Not the selling, general, and administrative, but the period cost. So let's look at an example of that. So again, remember, contribution margin income statement is not allowed for GAAP, but we start out with sales. We reduce our sales revenue by our variable cost to get us a contribution margin, right, and not a gross margin. And this tells us how much sales contribute to the coverage of fixed costs to get us down to operating income. And so again, this contribution margin statement is really used for internal management decision making. But there is a way that we should be able to, and in reconciling these two costing systems, we really see that the difference in operating income, right, because we calculated operating income under both scenarios. One, we used a functional approach to it. The other one, we really used we organized costs by behavior, that is, are they variable or fixed, right, rather than the functional. And so if we want to reconcile these two, we just simply have to take the difference or the change in the inventory level in units times the fixed manufacturing overhead per unit, because that fixed manufacturing overhead per unit, right, is what's tied up in, that's the only difference between the two, and that's what's tied up in the inventory account versus being for the absorption costing versus being reflected on the income statement for variable costing purposes. And so finally then we can talk about how these what's the relationship here, and what the absorption costing means for manager incentives. And one of the real weaknesses of absorption costing is that it can be manipulated by managers by trying to, the income statement and operating income, and if that's what their performance and bonus is gauged on, can be manipulated somewhat by manipulating inventories, because when inventories increase, absorption costing income is higher than variable costing because we have more period expenses associated with, we have more fixed operating expenses associated with the units of inventory versus being on the income statement as they would be under variable costing. When inventories decrease, absorption costing income is lower than variable costing income. And I think that makes sense when you just think through, what's sitting on the balance sheet under absorption costing that's not sitting there under variable costing. And so therefore managers may increase production to build up inventory to maximize income, and therefore they're in bonus if they're incentivized based on operating income metrics. And so we come to the end of Chapter 6. I hope this was helpful in helping you understand the concepts presented. Please, as usual, make sure we read that chapter and get with me about any questions or if anything's not clear. And thanks for your attention.